All right, Mr. Frost, welcome back. Let's jump right into it. Give the people what they came here for. Give
That's
us an
right.
update on mortgage interest rates. Where do we stand?
Well, this week's a bad week. Rates are, I wouldn't say it's a bad week, but rates are up from where they were last time. So we've seen um, it's like almost like a lack of good information. So now all the markets and this is consistent with this time of year, because when there's no, like, there's no real data there, like the government's kind of in, I don't want to say like a lame duck season, but everybody's kind of like in holiday mode, right? Like we're all fighting not being in holiday mode. So everybody's hanging on to just little bits and pieces of data. So we saw rates come up this week, like 0.25 to 0.38%. So, your better qualified buyers are on conventional financing is looking, 6.375, 6.25, somewhere in there on your 30-year loans. And then your government stuff, again, well qualified for government loans, is you're looking just below 6. So rates are still, the important part is rates are still trading well below their highs when we had all the rates are going to be 10 and 12% thing. And things are moving along just fine.
Yeah, so I mean tomorrow's a big day, right? So, or not tomorrow, next week. The Fed meets
Next
on the
week.
14th.
Yeah.
And
So we have two big numbers next week. So we have the most important one, because what happens on Tuesday is what they're thinking is going to drive what the Fed says on Wednesday, right? So the Fed meets for 2 days. They get all the geeks in a room and they all squabble in their own special way, and they figure out what they're going to do with rates. And most of them largely agree that this time around they should raise rates 0.5%. And that's already priced into interest rates. It's priced into the stock market and all that. But what happens on Tuesday, we're going to get the CPI report, which is the Consumer Price Index, right? And we are looking for that. We show that graph all the time where we're replacing the numbers. I think we're replacing the highest number on that graph, like a year-over-year number. So if that number comes in
when does that come
a
out?
lot of the
When does that
economic
come out?
indicators, what's that?
When does that come out?
Tuesday. So that's a Tuesday morning number. So they're hoping that if that report comes out good, that should drive the commentary for after the meeting on Wednesday, which is what really moves the market. Like they come out with a prepared statement that they all do unemotionally, and they just get all their datas in there. And then Jerome Powell says, any questions? Then he just destroys everybody's day. So we'll see how that goes.
Well, yeah, next week will be big. So here's what your boy Barry Habib had to say about mortgage interest rates, and then we're gonna talk about some other things in a second. But he said this, I quote, "Because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, 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 and lower. And as a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5% or even below 5% within the next 6 months." Your thoughts on that statement?
I think he's on track. I mean, like I said, it's going to be a bumpy ride to get there. A lot of the indicators and data and historical, these kind of things happening, that is where we're headed based on all the standard information. We did get producer price index today, which showed the headline inflation number year over year. It went from 8.1% this month last year to 7.4% this year. So you're talking a 0.7% decrease in headline inflation, which is a really good number. So we had some of the data that we got today was a little bit higher than what the bond market expected, but overall that inflation is continuing to move down, which is that pressure on interest rates to ultimately come down.
Yeah. And, because interest rates, I think, have gone maybe the opposite direction that some of the media wanted. Well, I wouldn't say that they wanted them to go, but the people that were campaigning for interest rates going north of 10%, now they have kind of changed their tune to attack the housing market from different angles. One of them is your other good buddy, Diana Olek. And I'm just kidding. So she just came out and she's
always negative.
Yeah. So she's attacking the housing market because these people can't attack interest rates anymore, right? I mean, interest rates are on a downward trajectory. So they're like, all right, let's attack it from a different angle. One of those angles is equity. The housing market's going to crash. Values are going to go down. Diana Olek tweets this, I don't know, it was a couple days ago. She said, homeowners have lost $1.5 trillion in equity since May. Well, you have to put things into context, as you and I like to say. So the reality is this. I mean, here's the reality. The reality is we're sitting at the end of Q3 in 2022, $10.3 trillion in home equity, right? And if you look at the last time the housing market crashed, you can see the difference in how low the equity positions are. Now, did we lose some equity because a slight downward trajectory in value? Sure. But if you look at the whole and we're sitting on $10 trillion of equity, I mean, we are a long way away from people walking away from their property, because the belief is foreclosures are on the rise, and that's going to cause the housing market crash. Your thoughts?
I agree with you. I mean, it's pretty, again, it goes back to, and some of the feedback we get is like, you guys have this, like, you're just trying to be positive or put a positive. I mean, really all we're doing is analyzing, like, there's like certain metrics out there that measure all of these things. I mean, there's companies that make billions of dollars measuring this data, right? And I mean, it's everywhere. And so if you go back to that chart and I always go back to like employment, right? Because if employment's at an all-time high, right? Our unemployment rate's like 3.7%. When you go back to like 2008, 9, and 10, unemployment rate was 10, 11%. It's like, and I know it doesn't seem like, 3.7 to 10%. Like, it's unfathomable to think about how many jobs. I mean, think about every job in America, right? And you're down, and there's like a 7% difference. It's just a massive amount of employment. So people now, like you said, one, you have all this equity to protect in your home. So they're looking for foreclosures to come in, which they think, and most humans think, or I should say consumers think, that by having foreclosures, it's going to improve the housing market. It's going to drag values down, because that's going to create an oversupply, or it's going to increase the inventory in the market, when really it's not, because that displaced homeowner has to go somewhere else, right? Yeah. So it's not doing anything to improve supply. And why? And like a bank would even have a hard time. I feel like any bank that you're going to foreclose on your mortgage, like, why are you foreclosing? Like, we don't want your house. Go list your house for sale. Like, you can, anybody, like, it's hard to fathom somebody doing that. I'm even seeing homes, like I'm doing helping a person buy a house right now, and she lost her home to a fire, and there was some weird stuff with insurance. She bought the home with somebody else. They quit claimed themselves off the home, but they kept the insurance in their name. And then they ended up, the house burnt down, and she had like a renter's policy on it, and it paid off like a good portion of the mortgage. And she sold the home burnt down and walked away with like 70 grand.
Right.
You know what I'm saying? Like, there's just, it's hard for there to be a foreclosure epidemic when there's a housing shortage and there's massive employment,
Yeah. Well, I want to go back to something that you just talked about. And by the way, I'm just going to be honest with you and the audience right now. I enjoy this format better, actually, than in the studio.
You do?
I do. Because I can
grainy and a slight delay, but those are things I'm going to get over.
Well, and the delay is just on the software we're using, but it comes out nicely. But I have all my stuff. But anyway, I want to go back to what you just said on, yes, the people that aren't fans of the way we're positioning. Well, we're not positioning anything. We're just reporting the facts. And they're like, oh, you guys are just being naive, whatever. You're in the market. You have a bias towards the housing market doing well. Let me make it really clear. This is why that statement is untrue. I would rather the housing market crash. I would prefer that it does, because I am an investor. So if I had a choice, hey, let's have the housing market like boom in the future or crash, I would prefer a crash, because I'm positioned very well for it. And so if there was any bias, and if there was any wishful thinking, it'd be on the side of a crash. So for any of you out there that think that, oh, we're just positioning the data, we're manipulating the data to support a narrative that the housing market's going to be better. Let's get real clear. I would prefer that it crash bad. I would prefer that the fear mongers are correct. It's just that the data doesn't support it.
Right. Well, and I think there's a lack of experience in it too. So I was reading that David Goggins released a new book, and he was talking about,
He did?
Like, there's all these, what's that?
He did?
Yeah, he's got a new book out. And he was saying that, there's all these people out there and these coaches and these mindset people. And he's like, in his own language, which is always better than the way I'll do it because we try to keep this PG-13.
That's right.
But he's like, there's all these people out there that do all these things. He's like, and he was talking about how he runs. He's like, I run with no cartilage in my knees. And he's like, my bones rub together. He goes, my body's not aligned right. He goes, but I can't come out here and tell everybody to be hard and stay hard if I'm not out here running. And he's like, there's so many people out there that are like, hey, you got to do this and that, but they don't do that themselves and nobody's looking. And if you think about a lot of the talking heads in the market, there's some economist info and things like that, but you have people that it serves them, but they're not actually doing. Like you work actively in the real estate market. Like I have been originating mortgage. Like I didn't take I wasn't like a bank manager, and I didn't do like a side job as like a fitness trainer or something like that. Like I have actively been writing mortgages since 2015. Like every day I come in and
since 2015, you mean since 2005?
Oh yeah, 2005. Yeah. So I mean, I've been sell myself short.
Yeah.
But I mean, I'm like actively in I'm doing it. So like I'm not. To your point, foreclosure market's great because I'm still running into people like, dude, housing prices are still high and rates are high. It doesn't make sense. But if I could have housing crash and prices are down, people aren't going to care about the rates. All of a sudden, now they're getting a good deal on the house. They'll refi later.
So let me just. Yeah, so let's speak to that. So
I went off on that tangent.
No. This is great. This is great because all the people that are now positioning, okay, we got to get off mortgage interest rates. We got to talk about something different. Well, foreclosures. Let's talk about foreclosures. Number one, mortgage debt, as you can look on the screen right now, literally historic lows. Like if you have to go back before 1980 to get to where we're at right now. Because people's debt to income ratio on their property is almost at its lowest point. That's number one. Number two, okay, let's talk about delinquencies, okay? So this, I'll show everybody. So you have to have context. The media having a frenzy. Oh my gosh, delinquencies are up, blah, 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 blah. Okay, put it into context. Remember, up from what? Up from 2021 when, oh, that's right, there was a ban on foreclosures. Oh, that's right. Yeah. So now you look at where they're at and you go back to when a housing crash actually happened, when there was 2 million foreclosures, we have 88,000. So yeah, do we have more now than we did last year? Yeah, we do. But when you put it into context, it's like, oh my gosh, those are historic lows. So much so, the NBA came out and said this. For the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the Mortgage Banker Academy survey began in 1979, declining to 3.45%. And so that's the fact, and so the discrepancy between 2021 and year over year, yeah, it's a huge, massive increase.
As a percentage.
You nailed it.
As a percentage. If you look at what the 88,000 homes is nothing.
I know. Yeah, it's crazy. It's crazy. So, kind of, I guess going back to mortgage rates, I just want to show this just so kind of everyone, to your point earlier, that it isn't just kind of your opinion and crystal ball type of speak. But if you have, you got Freddie, Fannie, MBA, and NAR. All right. And so maybe argue one is better than the other. But to end Q4, this is 2023 outlook. I'm sorry. So 2023 outlook probably isn't as great as Barry Habib's. But I mean, if you look, we're going to hover 6.5%. Maybe that's more realistic. I still think they're going to be lower than that, though, because we saw them go low. They are. I believe that, too. Go ahead. What are your thoughts?
I mean, just again,
Falling
being in
inflation.
the business, you know, I
Yeah.
mean, and I guess every company's got a different rate sheet, so maybe I see things a little bit differently there. But rates are not 7%, and really, I'm not even doing loans over 6.5 right now.
Yeah.
So again, it just, I guess maybe it depends on your market. It depends. I mean, if you're looking at like cash out refinances, which are down 96% year over year or something, you're going to see high rates. But that's like such a needle in the haystack in what the mortgage business is today. But most of the loan products, and you know, Fannie Mae and Freddie Mac have done some things with eliminating like certain cost adjustments in loans and stuff that have really significantly reduced that borrowing cost, regardless of what the market holds for rates.
Yeah. And one of the big factors going into 2023 is transactions, you know? And so like that's really the opportunity for the industry. Again, people are like, man, transactions are down 20-25%, which they are. But again, to put it into perspective, you know, if these are the projections for next year from Fannie, Freddie, MBA, NAR, and if we end up around 5 million home sales, I mean, we're going to come off of a market in 2021 where we did 6.2, something like that. I mean, you think about two sides to a real estate transaction, you have like 10 million transactional opportunities, you know? And so, and then giving that even more context in this is what's so crazy is somehow, some way, and I hear people say this and I just don't believe it, that if you look at the motivation of why people move, I don't believe that a couple wakes up and they decide to move or to not move based on what mortgage interest rates are. Hey,
Right.
babe, mortgage interest rates are down. Let's move. No. It's because they got pregnant. The kids left the house. It's because they got married. It's because they got divorced. It's because they downsized. It's because they upsized. I mean, these are the reasons why people move regardless of the market. Don't believe
Right.
me? I'll prove it. Let's go back to 2008, 2009, and the worst real estate market that world's ever seen. We still did 4 million, 4.2, 4.3 million sales. Still 9 million commission checks were handed out in 2009
Right.
during the worst time because people move regardless of the market is the point.
Yeah.
You agree with that? I
100%.
mean, you're building a house right
Yeah.
now.
Yeah. Because we got to know our neighbors too well during COVID.
Yeah, exactly.
Moving away from everybody.
Yeah. So I guess the last thing is, you know, there's some the pricing, home pricing, right? So this is a big thing. In certain markets, they're falling. In some markets, I mean, but overall, year over year, home prices are still up. They're up
10%.
They're up 10% year over year. Go ahead.
Yeah. So for this year, I think so. If you look at like CoreLogic figures which came out this week, so home prices are up this year 10.1%, but they're down. So the year over year number, right? So we keep every time we get into this year over year business is just a funny thing because it was we talk about it in another presentation we do about statistical anomalies, and you're comparing it. So it's down 11 the home price index is down 11.4% year over year. What that means is that home appreciation or the home price index was up 21.4% in November, or I think this report is this for October or November? It was October's report. So October of 2021, home prices were up 21.4%. And this year they're up 10.1%. So yeah, it's a massive decline in price growth.
Yeah.
It's not a massive decline in value that we're looking at here. This is price growth.
Yeah.
So
and so if you guys look at the screen,
if it was down 21%, that would mean your house stayed the same month over month.
That's right. That's right. And this is what you were referring to. So this is the Case-Shiller Home Price Index that just came out on the 6th of December. This is the most recent data. And the year over year, just to Steve's point, 10.1% increase in home prices. So we show you this, and here's their forecast for next year is up another 4% in 2023. We show you this. Why? Because the main headline right now is home prices declining, you know, all this down 20, 30, 40, 50%. It's just literally clickbait. That's literally the whole thing. Like there's no data to support that whatsoever. you know?
Yeah.
So
We like, I
anyway,
mean, that's better news. All right. Like people love that kind of news. You know,
yeah.
it supports that.
Well, it works. I mean, it absolutely works. You know,
Yeah.
we pump, the facts. I won't call it good news. We're just reporting facts. Nobody watches our show. If the shows that fear false information and manipulate the data, they get millions and millions and millions of people to watch their shows. So the reality is it works. So I understand why CNBC smashes these headlines because, dude, they're trying to sell advertising,
Yeah, for sure.
And Diana Olek, she's probably got a $10 million salary to sit there and smash the housing market on national television every morning. No one's
Yeah.
paying me. No one's paying me that to share the news. Believe me.
Yeah. And if you go back and look at some of Diana Oleg's, historical predictions and things like that, she doesn't have, like a lot of the people that are calling for, different economic events and things like that, or like their history on whether or not inflation is high or low and things like that. Like even with some of the Federal Reserve members, I mean, these people are publicly tweeting, their forecast or what they believe. And they're just, I mean, like tweet after tweet, month after month, they're wrong. And now they're coming out. It's like, oh, you're still supposed to be this like respected voice in this field, but you've gone ahead and made public information that's inaccurate. So you do, like, even with that Diana Oleg, like you have to take that with a grain of salt. You've got to have the discipline to go in and actually read that data and think about it, just the context of the data, and rather than just like what you think that headline means.
Yeah, and oftentimes the headline that gets the click will actually say the exact opposite of the headline. And so it's amazing. And so literally that is the proof that the title of the thing just to win the click is just that, is to win the click. That when you read the headline, when you read into the data, that it says the exact opposite. So like a real good one just came out the other day with realtor.com, and I was going to try to find it, but it was like, 2023 is in the housing market is doomed for 2023. And then in the data, it says the housing market in 2023 is going to be just fine. It's like,
yeah,
you just got to get the eyeballs. I mean, that's what their advertisers need them to do.
I sent you one last week from Axios. Remember, we were trying to find, I never
Yeah.
that Axios website. Like I go on there now, I'm trying to check it out. Like stories come and go. It's like a feed or something. You can't go back and get anything. I'm not cut out for that kind of nonsense, but there is an article there. I sent you the link for which disappeared, but it was the same thing. It said like home price crash coming. And then in the art, literally it said, in conclusion, housing market seems like it's stable and there is going to be demand to absorb this and that. In the last, the conclusion of the whole article was that like, it was completely contradictory of the headline, I was like, man,
it's craziness.
Wow. Yeah.
Let me hold on. I want to find this just because it's so good, and then we can end this for the people. This is so funny. I love this. Foreclosures. What is it called? Surging. All right. So realtor.com comes out with this thing. Let's see if I can find this. This is so, I just want to give people like context. Article. You know how like people on those big shows have like people that work for them on the podcast, like, hey, Susie Q.
Jamie, pull that up on the screen.
Yeah, pull that up. We don't have that, you guys. So Steve and I are having to do that ourselves. So
we should get a Google us. Like when our kids are out of school for the summer, they can come help us. So like Christmas break coming up, we'll just have them like sit in the studio and Google stuff for us.
Yeah, exactly. That's I agree. Housing trends.
Except for it'd be like getting ready routines, it'd be like the morning routines is what we'd be looking at.
Boom. All right. So check this out. All right. This is so good. I'll share my screen. This is hilarious, actually. So peep this. All right. Let's do a little reading. So here's the headline. Can you see my screen okay?
Yeah, I love it. It's a good screen.
All right. Foreclosures are surging. Repeat of the Great Recession looming. And then they go, so they talk about all the data. They're up 57% compared to a year ago, which is the default. We already talked about why that is, and so we gave some data.
Hang on, go back. If you go back, it says that 3,770 completed foreclosures or foreclosures were completed in the month.
Mm-hmm.
So just for perspective, if they did that in every month of the year, that would be 45,000 foreclosures.
Unbelievable versus like a 2 million, right? And then they talk about the foreclosure moratorium that was in place last year, which is why this number was so high. But I mean, literally, dude, they get further into this. So like they talk about the Adam executive vice president who's doing the research is that over let's see. So watch. It will take until the middle of 2023 for foreclosure activity to reach pre-pandemic levels. We haven't even reached that yet. Even then, it should represent a concern for the. I can't believe you're saying this. It should reach a concern, a big relief for anybody that's remembers a foreclosure crisis of a decade ago. I just want to see. It was so funny. I read this earlier in here.
Was this a complete reversal from where things stood in 2008 when 30% of homeowners and virtually everybody in foreclosure were upside down on their loans? So again, that goes back to that trillions of dollars of inequity. And it's hard to fathom because we're numb to what those numbers are. You know, like,
Yeah.
you know how many 100,000s are in 10 trillion?
Right. Anyway, it's just an example of like just winning eyeballs, and I don't know. It's amazing that people are still so damn concerned when there's a little movement, a little shift in the market, and everyone gets so emotional and they start quitting the business, and I'm like, man, I just things are fine. There's a house that sold in my sub, dude, crazy. I mean, just crazy high price. We're all like, I can't believe it. You watch the news, you feel like it's Armageddon. Then you go into real life, like we're not talking about Avatar world, the real world, and it's like everyone's fine. Shopping lines are long. People are still buying $400 Jordans. The mall's smashed. Lines out everywhere. I don't know.
I had some data on that. So this is getting off like the housing topic. So they were it was so like you go to the mall, right? And like I go and I still see people. I'm like, man, how does that kid, because I'm 40, so everybody that has like a nice head of hair is a kid to me, sorry. But I saw this, they're walking around. So did you know that, so luxury goods, right? So we're like Louis Vuitton, Hermes, like all those brands.
Rolex.
So Gen Z is responsible for 40% of the purchasing of luxury goods. And they say that Gen Z are people that were born between 1995 and 2015. So you're talking about people that are that young, 17, no, it's 2005. I'm sorry, 1995 to 2015. So you're talking 17 to 27 years old is making up 40% of luxury goods purchases.
How is that even possible? It's crazy.
Well, so it goes back to, you know, again, part of the reason that inflation is high, right? So the reason inflation is high is because there's a ton of money out there to buy things, and there's not that many things to buy, right? Because that's one thing. Like luxury goods have done that forever. Like even if you think about like a Lamborghini or a Ferrari, they will make the greatest car. Ferrari could make they could make $1,400,000 cars, and they would sell every one of them. So what does Ferrari do? They make like 300 of them.
Sure.
Because they know that it's a privilege to have that car, not only to own it, but to get your hands on one, right? And these luxury good manufacturers, while it's not the same scale, but they make it harder to get. And so what happened is we pumped trillions of dollars into the economy over the last couple of years, which, yes, like, and everybody thinks that right up front about being like stimulus checks, but it's not. It's also having relaxed monetary policy, which has allowed corporations and big companies to pay all-time high wages, which is putting a ton of money in people's pockets. And there's a ton of like side hustles now. So you can work, like I know people that work full-time corporate jobs. And like, dude, I don't have anything to do on the weekends. I do DoorDash, make like $500 or $600 a weekend, which I'm like, maybe that's how people are buying Jordans. Maybe they're just popping a little DoorDash.
Yeah, maybe. So listen, next week, you guys, there'll be a lot of things that to share that will drive mortgage rates and the housing market as we get into the beginning of 2023. And like always, we'll bring you an update every week with what's happening. We can bring you the facts, and then you can take those facts to help navigate your life. You know, whether that you're in the business or you're a consumer, you get to decide what you want to do. Our job is to bring you the information. You get to decide what you want to do with it. So, Mr. Frosty, appreciate you like always.